Hello, everyone. We're looking at the Bitcoin weekly chart on screen today. A halving is the event when the reward for mining new coins is cut in half, roughly every 4 years. Historically, price has moved hard around these events. But is that really always true? Halving equals automatic profit?
No.
The real story is different. Today we'll verify the actual pattern on past charts and the risks hiding behind it. On the Bitcoin weekly chart on screen, you should see about 4 kink points. Those are the halvings. Bitcoin was designed for scarcity from day one, a bit like gold having a finite supply. Miners earn a reward each time they confirm a new block of transactions. After about every 210,000 blocks, roughly every 4 years, that reward is cut in half.
For example, 50코인즈 at the start 그러면 25 그러면 12.5 and so on.
That cycle hit in 2012, 2016, 2020, and 2024. When supply slows, what matters more?
Demand.
That's the core idea. History shows something interesting. On the Bitcoin chart on screen, price generally rose in the 12 months after each of the 4 halvings. Example, after the 2012 halving, Bitcoin went from about $12 to $1,075 in roughly 12 months, nearly a 90 times move. But not every cycle looks like that.
2016, about 플러스 294%. 2020, about 플러스 540%.
It starts to look like a pattern. And after the April 2024 halving,
운이 about 플러스 35%.
the textbook says halving equals profits. Reality says otherwise. Why was this cycle weaker? Let's dig into that next. Look at Bitcoin in 2024 on screen, the high printed before the halving around mid-March. 4 days after the halving, April 20th, the chart was already down about 10 to 15% from that high. Supply was slowing, so why did price peak early and then fade? This cycle didn't rhyme with the older ones. It wasn't one cause, it was several. Spot Bitcoin S-listed, and institutions had already bought heavily. While Fed rate policy, S&P 500/Nasdaq risk appetite, and trade tensions collided with the supply story. In short, slower supply is necessary, but not sufficient. Sentiment and the macro backdrop, especially the Fed, often matter more. Now look at the Ethereum daily on screen. Crypto trades 24/7, 365 days a year. Unlike the NYSE or Nasdaq, it never closes for the weekend. Think of it like a coffee shop that never locks the doors. Open when you're asleep, open on holidays. That constant flow is why swings get so big. A 5 to 10% day is normal. A new shock can move 20 to 50% in one go, more like a 3 latte jumping to a 4.50 overnight than a blue chip stock tick. Volatility is simply how often and how far price moves, similar to the standard deviation you'd see on an equity. High volatility equals big upside opportunity plus big downside risk. 2 sides of the same coin. Add leverage, borrowed money, and that swing gets magnified 10 times or 100 times.
A 5% move becomes A 50% loss.
So risk management is mandatory. Stop losses, position size, minimal leverage. Next, a hard lesson from real liquidations. Look at Bitcoin perpetual futures on screen, a contract that never expires. With 10 times leverage, $10,000 controls a $100,000 position. 10 times the upside and 10 times the downside at the same time. Concrete example, long at $80,000 with 10 times leverage, and your liquidation price sits near $72,000. A 10% drop can wipe you out automatically. When you're liquidated, the exchange force sells your position. In that scramble, extra slippage and losses can pile on. On top of that, funding fees hit about every 8 hours. Just holding the position costs money, like an expensive revolving credit card rate. A small entry mistake plus forced liquidation plus funding drag can erase your entire principal. Absolute no-go for beginners. Back to the Bitcoin weekly on screen. First, a halving slows supply, but it can create demand. Macro, the Fed, risk assets like the S&P 500 often dominates. Second, crypto is open 24/7/365 and highly volatile.
서든 50% 무브즈 해픈.
Third, leverage is a double-edged sword. Expect 10 times gains, and you also accept 10 times losses. Absolute no-go for beginners. If you invest in crypto, only spare cash, longer holding periods, stop losses set, and leverage only after you've learned, in tiny size. This lesson is educational, not investment advice. Every trade is your responsibility. Past halvings paid off for some. That does not guarantee the next one will. Read the chart yourself and decide for yourself.